For years, Washington state has this reputation, right? A low tax haven, especially if you're a high earner. Well, that whole reality is about to get turned on its head, and I mean dramatically. There's a major new tax coming, and we're going to break down exactly what it means, and more importantly, what you can actually do about it before that window for action slams shut. Okay, let's get into it.
This quote right here, it nails the new reality perfectly. Think about it. You could have two people, both earning millions of dollars in Washington. One of them might end up paying a massive tax bill, while the other pays literally zero. The difference isn't how much money they made. It's not luck, it's all about how they planned ahead.
So here's the timeline we're all looking at. Before 2028, Washington is the state we all know. But on January 1st, 2028, everything changes. This new 9.9% income tax, they call it Title 82A, it kicks in for anyone with income over $1 million. And that makes the time we're in right now. Today, 2026, 2027, that's the absolutely critical planning window.
To really see how high the stakes are here, let's walk through a scenario that shows just how much planning can change things. And look, this isn't some theoretical exercise. These are the actual numbers in play.
Okay, just look at the difference here. It's staggering. So we have a founder, they sell their company for $15 million. Great exit. In one scenario, with a specific plan in place, their taxable gain is zero. They pay zero in tax. They keep the full $15 million. But without that plan, maybe they're just a standard S-Corp. Well, the entire $15 million is taxable. Their total tax bill is over $5 million, so they only get to keep about $10 million. It's the same exact exit, but two wildly different outcomes.
Let's just let that number sink in for a second. Over $5 million. That is the price tag. That is the cost of inaction. It's the tax bill for not having the right structure set up before you sell. I mean, that is just a mind-boggling amount of money to leave on the table, all because of a lack of planning.
All right, so how do you make sure you're not the one writing that $5 million check? Well, the secret is understanding how Washington is now going to tax income. The whole thing really boils down to thinking about three different buckets of income, because the state is setting up a system where each one gets treated very differently.
And here is the absolute core of it all. Your regular earned income, so your W-2 salary, your business profits, that's going to get hit hard with that new 9.9% tax once you're over $1 million. But, and this is the real game changer, certain types of equity gains, especially from qualifying startups, could potentially be taxed at 0%. That split right there, that's the key to everything.
So that brings us to our first and, frankly, most powerful strategy, QSBS. That stands for Qualified Small Business Stock. Now, what's interesting is this isn't even a Washington rule. It's a federal tax code. But because of the way Washington wrote its new law, it has this massive impact here. It's basically a provision designed to let you wipe out the tax on gains from certain startup investments.
And the power of this strategy is it's incredible. QSBS can wipe out not just the new Washington tax, but the federal tax too. We're talking up to $15 million in gains that can be 100% tax-free. Now, there are some catches, right? Your company has to be a C-Corp, you have to hold that stock for at least 5 years, and this is the most important part, it has to be structured before you sell. You can't do this last minute.
And that takes us right back to that first example, doesn't it? I mean, using the QSBS strategy is literally the difference between walking away from your $15 million exit with $10 million or walking away with the whole thing.
Okay, let's talk about strategy number 2. This one is for anyone who has some flexibility in where they live. It's called a domicile change. And domicile is a very specific legal term. It's not just where you own a house or get your mail. It's your one true, fixed, permanent home. And making a real, provable move to a new state can be an incredibly powerful way to just step outside of Washington's tax system.
So, what kind of impact are we talking about? Well, if you're earning $3 million a year, a successful domicile change could save you almost $200,000 every single year. But, and this is a big but, you can't fake this. It has to be a genuine, well-documented move. Auditors are going to look at everything. Where's your doctor? Where are you registered to vote? Even where are your pet's vet records? And the single biggest mistake people make? Keeping a fully furnished, ready-to-move back into home in Washington. To an auditor, that's just proof you never really left.
So yeah, for people who can genuinely relocate their life, this is really the most definitive way to get out from under this new tax regime. It's a huge decision for sure, but the financial impact is just undeniable.
But what if you're a high-earning professional? A doctor, a lawyer, a business owner, and you're staying in Washington? What do? Well, that brings us to strategy number 3, what we're calling the professional's playbook. It uses 2 key tools, something called the PTE election and a technique called retirement stacking.
So here's how this 1-2 punch works. First, for business owners, this pass-through entity or PTE election lets you take that 9.9% you pay to Washington and deduct it from your federal taxes as a business expense. That's a huge savings right there. Then, step 2 is you aggressively use certain retirement plans, like a cash balance plan, to make massive contributions that directly lower the amount of income Washington can even tax in the first place.
And what happens when you combine those 2 moves? Well, for a lot of professionals, it can slash the effective rate of this new tax all the way from 9.9% down to below 5%. So you're still in Washington, you're still earning, but you've cut the cost of this tax by more than half.
Now, we've got to talk about the final and honestly the most urgent piece of this whole puzzle. All of these powerful strategies we've talked about, QSBS, a domicile change, major business restructuring, they all have one big thing in common. You absolutely cannot do them at the last minute.
This timeline just lays it all out. We are in the planning window right now. By the time we get to the end of 2027, that's really your last chance to pull the trigger on these big structural changes. Because once that calendar flips to January 1st, 2028, the tax is law. And for many of these powerful options, the game is already over. They're locked in or they're gone for good.
The source guide for this explainer puts it about as bluntly as possible. By 2028, the decisions that have the biggest impact are already made. A lot of high earners are going to overpay, some by millions, for one simple reason. They waited too long to start thinking about it.
So that's really the key takeaway here. Washington is going through this massive tax shift, no doubt about it. But the real moves, the real strategy, it isn't about what you do in 2028. It's all about what you do right now. The plan for dealing with this new reality is being written today. So the only question left is, what will yours say?